Good afternoon, everyone. Evening for some, morning for others, all over the world. Welcome to today's call. And we have a ton of stuff that we're going to be covering today. The schedule, as you can see here, is we're on Monday, March 29th. I did change, yes, I did change it. And I put everything because everything is on the table right now. Of course, SPY's basically at all-time highs, back up after Thursday as we ended the call on Thursday and going into Friday. Friday, of course, the market moved up significantly, bounced down a little bit this evening or this morning, and then it's back up again. So right before the call, trading around 396. So there's just all sorts of stuff that is available that we're going to be looking at and that has come back into play, including some stuff that, quite frankly, I forgot about. And lo and behold, I had an order filled this morning on some crazy calendars that I had basically left for dead because the market had moved down so far, and we were in the short 396 call. So you may or may not remember those. We'll touch on those. Some other crazy calendars, option insanity, as well as what we started on Thursday, which intrigued a few people. So the cash flow spreads in SPY, we began to explore that a little bit. We'll go into that some more today, as well as obviously the market has moved up significantly. And of course, I took a trade on that, so we'll update that as well. All right. For those that are new on the call, I do want to welcome you to the call. However, I do want to warn you that I do not explain everything about these trades on a single call. It's impossible for me to do so. These calls are meant to be cumulative, so you continue to add to your understanding, you add to your wealth of knowledge on these types of trades. And it usually takes a few months for traders to really, if you've never been exposed to the type of trading that I do, it's usually at least a few months before you start to get comfortable with your understanding of it. It's not difficult. It's just a little different than what most traders push you at. So don't come onto this call if this is your first time and go off the call and say, well, I didn't understand a thing, and then never come back. There are many, many traders on here who will tell you that is a huge mistake. So don't expect to understand everything on these calls, okay? And also, you will see some good trades on the call. Some of these trades are absolutely fantastic. And if you do see that, you still need to be careful about how you approach this strategy, because there is a level of complexity to this. There are areas where you might make mistakes, and you don't want to make a mistake. You don't want to see a trade and say, "Oh, wow, this is a incredible trade. I'm going to get in with a 10 lot, a 20 lot, 50 lot, whatever it is the case, because you have a big account." Big mistake. Don't do that. Start small. There are things that you might not take into consideration. There's things that you might overlook. You might make a mistake. I made a mistake in a trade on Thursday, and it was a really dumb mistake, but it nonetheless was a mistake. It ended up actually working out in my favor. That doesn't necessarily happen a lot, but mistakes will be made, and you don't want to be over trading your account and make a mistake that ends up costing. So start small, don't be reckless, and make sure you follow the instructions on how we put these trades together. And one of the reasons I say you want to start small is because you don't need to have the holy grail strategy in order to do really well in the markets over a long period of time. In fact, if you can just consistently average a little bit of profit every week and then compound that over the course of 5 years, you're looking at significant growth, far better than normal stock investments. And so, over a 5-year period, if you're in a buy and hold stock investment or a mutual fund or whatever you have 5,000 in, over a 5-year period, if that doubles, you've done really well. But if you only average $10 a week and you compound that according to my compounding plan, you're talking about turning a $5,000 account to as much as $35,000. And if you can increase that weekly average to just $20 a week, you're talking about growing it to $135,000. And as you can see, the compounding, a little bit of increment on the non-compounded side has huge effects after you go through the compounding process. $50 a week, you're at $845,000 in 5 years. That's ridiculous. That's like unheard of type stuff, and unless you're familiar with compounding and the power of compounding. So our goal is not to create these just monstrosity, massive winning trades, or this massive profit producing approach. All we're looking to do is make a little bit of consistent money every week and then compound it. That is the absolute best way that anyone is ever going to create wealth in the markets. All right, and here is a copy of the exact compounding plan that you can use for some of the strategies, not all of them. Some of the more efficient strategies, including the crazy calendars that we're talking about. And this one is starting with 2,500. You can start with 2,500. You can start with 5,000. Doesn't really matter unless you take on some of the larger risk trades, at which point you need to go a little bit larger in the account size. But if you can get to where you're averaging $100 a week, you're talking about growing your account to as much as $35,000 in just 6 months, right? So the compounding can kick in early, but most people aren't going to come in here and average $100 a week to begin with. So it is something that you can look at building up to. And then, of course, after 5 years, you're talking about almost 3.4 million after compounding, and it's just a math thing. It's not anything, it's not some pie in the sky, ethereal, subjective anything. It's math, and it's not going to be exact because of some of the other mathematical fluctuations in the trade size that are going to occur on your journey toward that, but it's going to be really close if you can average $100 a week. Okay. All right. So some of you, again, you've been interested in the hedge fund where we trade some of these strategies in there. It's not a major piece of the hedge fund. The small hedge fund that I trade is really more focused on premium selling, and then we add in mainly some option insanity, and every now and again some other of these spreads that allow us to cross compound. And this is the performance as of this morning. And you'll notice last week we took a little bit of a dive in SPY. We made that up. Actually, this is as of the close Friday because SPY was down this morning. But we made that up on Friday in SPY, and we didn't quite make it all the way up on the fund. The fund is up. This is since February 9th, which is when I started keeping track of the daily equity. And so up about 3.94%, a little bit better than that today. And then in comparison, SPY during the same time period is up about 1.33%. This week is bullish, by the way, guys. It's bullish going into Easter. It's bullish on April 1st, which is Thursday. Now, Thursday is not the best first calendar day. If you're not familiar with that, first calendar day is a bullish day. It's the most bullish day that you're going to run into as far as short-term seasonals are concerned in stocks. If you would have bought just on the close of the day before the first calendar day and exited at the close of the first calendar day, so basically one full 24-hour cycle, and that's all you did, you would have about 85% of what the buy and hold produced since the mid 80s. That's nuts. Now that doesn't include dividends, so that's the only caveat. But from a movement standpoint, that's where it happens. And so we're coming up on that. Thursday is not the most bullish. Wednesdays are actually more bullish when the first calendar day occurs on Wednesday. That's actually more bullish. But going into Easter is also bullish. So you've got kind of a double whammy. And I think this week we're probably going to peak above 400 for the first time. Maybe go a little bit beyond that. I've been talking about that for a little bit now. That I think that they're pushing that, and after that, I don't know. I mean, I don't know that they're going to push it to 400. But if they do push it to 400, after that, I don't know. There's just some weird stuff going on. Some little warning flags that I'm seeing every now and again, subtleties that concern me. It may be nothing, and then again, it may be something. Um, and it's just kind of a grouping of that. So if you're not hedging, I would strongly suggest hedge. Of course, that goes outside of what we're doing in this group. Pretty much everything that we do almost has a credit, and that's that's the one that one criteria that I like to keep a constant as much as possible with the TPO strategies, and that is so that if stocks do come down, I've got other strategies that are going to make money if stocks move up, but I want my TPO strategies to make money also if stocks move down. And so one of the big ones that I do is, of course, the 5-1 option insanity. And this one was actually exited. And this one exited pretty much for the maximum credit. And then we replaced it, and where's my replacement? I guess I didn't upload my replacement. So I replaced it, and I ended up doing, and the way you have to put these on, by the way, so this is option sanity 5-1. We're selling 5, buying 1, selling 5 of the Monday options and selling buying 1 call that expires before it. And that's what creates this nice big bubble. And if you create this big bubble, actually, this is the big bubble. And what I did in this one is I actually exited 2 of the shorts at 50. That's what created this big bubble. And I thought I updated this, but I didn't. So this is the last trade, and I'm already out, even though it's not April 5th yet. When the market dropped significantly, we got out of this, pretty much out of the whole thing. And I thought about getting back in, but I went ahead and replaced it with another. So anyway, this creates this big bubble, and um, there is a break-even level up here. But what we're trying to do is we're just basically trying to create a credit and push the break-even way up there so that we have a really high probability of success on this trade. And so that it has to go through this profit bubble before it reaches the risk. And hopefully it won't do that immediately. But what I did on the replacement is that I put in a 3-1 order because they don't allow me to put in a 5-1 order. They're not gonna fill it. So 3 is the maximum you can do on a leg size. And so I did a 3-1, and then I went ahead and sold 2 401 calls. And I got filled on my 2 401 calls, so I sold short 401s, but then I didn't get filled on my 3-1. And so I basically had 2 short calls. Well, yeah, that created a scenario where I have a break even at like 402.25, and that's a 412 expiration. And I will make sure that that gets put up there on for Thursday's call, so you can see a visual of it. But on that one, with the market moving up, I'm actually going to add another 5-1 to that mix. And I could do the 3-to-1 right now and get filled on it, but I'm gonna push it up a little bit further for this week. All right, so let's see here. Why is that there? Oh yes, that is the trade, the cash flow spread trade that we were filled on at the end of Thursday, and of course, the market was trading, I think, around 389, 390, and this actually expired on Friday, and of course, Friday the market shot up. So I'll talk a little bit about that here in a minute. But before I get to that, I wanted to talk about a trade that I'd kind of left for dead, so to speak, if you will. And that trade was where is it? Here it is. That trade, let me get rid of the exit here. All right, I'm going to bring this in. Here's the trade that we put on. This is kind of the beginning of a risk-free crazy calendar, and we're basically doing it on Monday expiration. Okay, so so this is the trade, and this is what we're filled on. Is short 4-5, that's Monday, 391, just one of those. Long 3 of the 4-7, 396s. So again, that's Monday short, Wednesday long, and short 2 396s of Monday. All right, so it's a 1-3-2, or if you want to do 2 shorts first, followed by the long, it's a 1-2-3. So the calendars here are the 396s. Okay. And you can do this a couple of ways. You can do this where you have 4 and a 3. And that's what that creates, right? You still have a pretty decent credit on it. Or you can do a 3-2-3, and you have a bigger credit on it, and decide what to do. You know, if it's more bullish or more bearish, you know, however it is you want to do structure the trade. I chose to go a little bit more bearish on this particular one, and the whole process here, what we were wanting to do was a profit stacking type scenario. And of course, we were talking about profit stacking a few weeks ago, and profit stacking is basically where you exit part of the trade, or you add to part of the trade and then exit at profits, and then wait for the trade to come back into your fill price again, right? So what we did on this one is I said, okay, I've got in at a credit of 180, this whole thing, a 132, whole thing's in at a credit of 180. So what I'm going to do is I'm going to exit one of these 396s, one of my short 396s, and I'm going to exit it at $1.80. And so at $1.80, I'll take $128 profit on a partial of this position. All right, so let's see what happens, because I did do that, by the way. So that was the plan, and the plan was executed. I think this was filled like the next day after I put on this overall spread. And as you can see here, let me change the perspective just a little bit. What happens is this is the trade that's created, and it's actually a little bit better than that. So we'll just, Wednesday options tend to do a little bit better than Friday options. I don't think it's going to be that good, but I'll show you that in a minute. Nonetheless, that's what it technically creates. And then the purpose of this is then to resell the 396. So I exited at 180. That means the market either went down or enough time went by to get filled on that exit, that partial exit. And I did it at 180 because that was my original credit. And if I do it for anything less than 180, what happens is I create a debit overall on the trade. So when I exited that one short at 180, that took away the 180 credit. So I was exiting $180 worth of extra credit that would have been on the trade, which leaves me with a 0 credit. Okay, now the reason I do that is so that I still don't have any risk if the market tanks. And the market did tank. And I wasn't worried about it at all because I had no risk. But I also didn't know or didn't think that there might be, with the market tanking as fast as it did when we got into this trade, it just kind of looked like it was something that I was going to hold on to. And so let's take a look at this here. 396 is, this is PDS Trader, of course. And 396 is the long call. So that is that peak right there. And of course, that's also where the calendar is. And leg 2 is the long. And this is projecting that if you take a look at leg 2 here, if on 4/5, okay, on Monday, April 5th, if SPY closes at 396, okay, which is going to make that Wednesday long option at the money with 2 days left, it's projecting that that's going to lose basically $4, and I'm in 3 of them, right? So you divide $4 by 3, that's $1.33. So this is projecting that my long is going to be worth 340 minus 133. And so, of course, 340 minus 133 is going to be 207. And that's what it's projecting this long to be at the close on Monday, 4/5, if SPY is at 396. Now, why am I going through that process? I want to see how close this graph is. Because the volatility, this is a projection, and no one is ever right. This is like golf. You're never going to have a hole-in-one on every hole, and you're going to be off a little bit. It's just a matter of how much you're off. Because again, there's no calculation on the face of the planet that can do it accurately. It's a projection. It is not an absolute. And that's one of the complexities of these types of trades, is that little bit of an unknown. That's a little bit better on Wednesday than it's a lot better on Wednesday than it is on Mondays. But we're going to take a look at current prices in order to give that comparison. All right, so, and we'll get to the rest of this trade here in a second, but I want to go through this process. You can never go through this process enough, in my opinion, to understand it more and more and more. So as of right now, this 4.7 is equivalent. This is equivalent to a 331 today, a 331 expiration. Okay. And the market right now is trading right under 396. And the Wednesday 396 call, so it expires in 2 days, is trading, looks like, at 204. And by the end of the day, we've got another hour, a couple of hours. By the end of the day, it'll probably go down a little bit, although we're trading at 395.5. So that's actually out of the money by half a point. And so this is something that is going to be pretty accurate. That's going to be really close. This is projecting 207. If we go up another half a point right now, we might close around 207. So we're just going to pop this off just a little bit. We're going to drop that volatility down just a little bit. And this kind of is, if we were to do nothing with this trade now, this is projecting to be a risk-free trade based on the current data. And again, who knows where it's going to be? The volatility is going to be in a week, but this is going to be really close. And if it's off a little bit, it's going to be off, and it might in one of these what I call dead zones. It might lose a little bit if you actually hold on until expiration, but rarely is there a reason to hold on to these till expiration. So this is what I have. Now I can leave this as it is if I want, right? But the whole purpose of this is to try and stack profits. I don't want to just take, a $50 profit, which by the way, you can take right now on this trade total. In fact, you could have taken a slightly bigger profit on Thursday with this trade. So, one of the things that I'm wanting to do is stack profits. Now, I've already exited one of my 396s, right? So I was short 2, I exited 1 at 180, now I'm short 1. Well, if I sell a third one, so now I'm short 2, exited 1 at 308. This is the graph that is now created, and I bumped this profit way up there, $400 potentially. But that profit goes away pretty quick to the downside, or to the upside. So if SPY moves up, which it's a bullish week, so it is something that needs to be considered. If SPY moves up, then say by the end of this week, then I may be holding on to a small loss, even though I sold this 396 for another 308, which by the way was filled. And that break even on that 308 though is 399, or excuse me, the 396 call, because it was sold for 308. That break even is at 399 on those shorts. So that's actually pretty good, which is why this is still projecting a profit at 399. And again, you'll have to remember that I've already closed out a profit of $128 on partial of this trade, which is included in this graph, by the way. All right. So that's one thing that you can do. And I did that on partial of this spread. I was in a multiple lot size on this particular spread. And so on one of them, I sold this. But what if you're bullish? Well, first of all, you can be bullish, and what if you're wrong, right? And the market moves down. Now you've got this nice big profit. But if you're right, the market does move up. What's your risk here? Look, at 402, it's projecting at about $115 loss on this trade. So there's not a lot of risk. The probability, you put this trade on 100 times, and you're going to make money, because the market's not always going to move up like that, and it doesn't have to move up anywhere for you to make a significant gain on this particular scenario. But what if you're like, you know what, I've got this trade on. All right, let's pop that back down to what we had here. So I've got this trade on, and I really think the market's going to move up. And so there's really, I mean, if you're wrong and the market moves down, you're still going to make some money, right? In fact, you could still pop out $50, $60, $70, which is not a huge gain, but go back to the compounding. We're not trying to make these these killer trades. So you can sit on this, or you could, instead of doing another 396, because you've got an extra long here, right? You've got one short from 391, you've got one short from 396 because you exited one of them, and now you've got 3 longs. So you can do one of several things. You can exit one of these longs at a profit and drop it down. You could and just set a target, and you could do that, or you could say, you know what, instead of selling another 396 for $3, I'd rather sell like a 398 and push that up a little bit, right? And so if I sell another 398, let me update the price on that. It's going for 207 right now. If I sell it, look what happens by selling a 398 instead of a 396. Now I've eaten away. It's not going to be a $400 gain if the market tanks, but it is going to be about a $200 gain. But look at this. It pushes that way up there. My risk is very, very small. My total credit on this is 387. Okay, total credit 387. And I know I haven't done this with you guys in a while, so I guess I probably should go ahead and do this. How do we know that the risk is so small without looking at the graph? Well, we do just some simple math. We do the strike difference between the shorts and the longs. So I've got one short and one long with a strike difference of 5. And then I've got one short and one long with no strike difference. So now the total strike difference is still 5. And now I've sold a 398. And the strike difference between the 398 and the 396 is -2. So now my total strike difference is at 3. All right. So that is basically how you determine what it is that the risk is on this trade. And I got in at 180, right? And I took a 128 profit. And so add everything together, and you're talking about a very, very low risk of like, I think it's like $70 max risk to the upside if the market skyrockets. Yep, 75 bucks, basically. All right. So that's how you determine that. But of course, you can see it on the graph. This is a tremendous, tremendous trade. Again, you make this 100 times, and you're going to do really, really well because the market's not always going to move up like that. So you can do that, and there's no issue. You instead of selling another 396, you can push that risk away a little bit by going with a higher strike call. If you're like, you know what, why in there? Why not do a 400? Well, you're going to bring in less premium. So that's the first thing that you have to realize. So it's totally dependent on how much premium that you bring in. But by selling a 400 instead of another 396, now look at it. There's no risk. No risk to the downside, no risk to the upside. We do have a dead zone here, but it's way up here at about 150, and we've already adjusted the volatility of the longs to where that's probably going to be pretty accurate. This is what's called profit stacking, because what happens is if I do this, which I did do this at $1.25 on some of them, I can now start adding brand new trades to this, and I can just let this one sit. Or I could then turn around and say, okay, I'm going to go ahead and I'm going to exit this one at, let's say, 25 cents. And now I've got that, right? And at that point, I can say if the market moves back up, I'll resell. Let's say I resell the 121s. All right. So, of course, we don't know what's going to happen. All I'm telling you is, this is how you can profit stack. You can stack those profits, and because you've created risk-free scenario, you can begin to add on to those as well. All right. So, all right. So we're trading right at 395 right now, and the 395s. The Wednesday 395s are going for, wait for it, 215. So that's going to be, so this is going to be really, really close to what the, I dropped it down, so it's actually going to be almost perfectly accurate, unless some crazy stuff happens. All right. So that's the trade. Again, I'd after the market moved down, I didn't think there was a whole lot of chance of getting filled on the 396 again, or anything for that matter. But this is the thought process of what you can do as you're going through this. All right. So if you've anyone that took this trade, I want to hear from you. Let me know what you decided to do on this, et cetera, because this was an official trade that we took during the session. It wasn't filled until like 3 minutes after actually it was at 3:03 Eastern, so we were actually still in the call when it did fill. The first exit happened the following day, and then we've just done nothing with it, and we just sat here and waited. And sure enough, the market has moved back up. I'm almost for certain this would have you could have done this on Friday, and I did not. It's one of the mistakes that I made. I did not have an order working. Yeah, so that's one of them. I actually made 2 mistakes last week. That was one of them. No harm on either one, but that was one of them. The other mistake was I was placing a similar trade like this on, only it wasn't quite like this, and I put the long call, short calls, and then one of my strikes, instead of a call, I put as a put. I sold a put instead of a call, and fortunately the market did go up, and I was able to exit that, and then I was actually able to replace it with the proper call at a much better price. So again, that one worked out, but if I sold a put instead of a call, if the market would have tanked, I'd be naked a put in SPY, which is for me a no-no. So that could have been a very costly mistake. It could have been a very costly mistake. So you can make mistakes. I still make mistakes every now and again, and that's why you got to be careful and make sure you don't overdo it with trade size. Now, if SPY would have tanked, I would have been really ticked that I made that mistake. But I didn't make it with a trade size that I, that's going to cause a problem. Now, that's just something, and I think I did it because I am selling puts all the time in individual stocks, and you kind of get used to sell put, and then and then you switch over to TPO, and we're doing everything in calls. So that's that. All right, let's move on. And if you have any questions on this, I'll take questions at the end of the session. So that's the first one. It's going to be a tremendous trade no matter what happens now. Let's go to the next. I'm going to pull this down, and all right, let's go to some crazy calendars, which are available. So what I wanted to do is I wanted to take a look at the Monday, Wednesday, the Monday, Wednesday crazy calendars, crazy calendar strategy, because it's Monday, and Monday, Wednesday set is expiring. So I want to take a look at the prices based on where we're at, and right now we're trading at like 395.18. So 395.18. And here's the 386, 390s. Okay, so this is a 4-point difference. And I'm short 1, 386, long 4 390s, and short 3 390s. So I've got 3 calendar spreads and 1 diagonal spread. All right, so I'm short 1, short 3, long 4. Essentially, it's 1 diagonal spread, 386, 390 diagonal spread, and then 3 390 calendars. That's what this trade is. Okay, this is in the money right now by 5 points, and it expires today. And I want you to see where that's at right now. This is in the money by 5 points. What does being in the money by 5 points mean exactly? Well, let me show you. Let's see, where are you, Mr. Magoo? Well, I thought I had it. Let me pop it up here real quick. Good enough. This one, here it is. So here is a 454547. This is exactly the same trade, only it's a diagonal with the 397 short, and then the calendars are at 401. All right, so it's exact same trade. This is showing at a debit of 01. You can probably get it for a credit of 01. The profit zone is up here at about 401. And then, of course, as the market, if the market were to continue moving up, you're talking about eventually seeing a loss. All right. So that's that graph. I'm going to switch back and forth here real quick. This is at a credit of $1.39 right now. In other words, if I were in this, so let's say I'm in it from a credit of 0.1, because the market was, let's say, trading at 382 at the time, and I got into this call at a credit of 0.01, and then the market moves through and right past my profit zone, which is the 390 is, in this particular example, is exactly correspondent to the profit peak of this graph, which is on this one 401. All right. So we're trading at 395, which means we're trading 5 points above this profit zone. So this is 401. That means that we would be trading, we'd be going to 406. So this one goes to 405. So we'll go to 406. We'll push it up to 406. And this one is projecting a loss of about $224, which is really reasonable. But the reality is that the risk, the loss, the open position loss on this exact trade right now, that's 5 points in the money, is only $139, $140. If you got in any credit of 1, then that's $140. That is a huge move to the upside, by the way. And that's one of the reasons why I say, with these Monday, Wednesday crazy calendars, the probability, if you're going out of the money, if you go far enough out of the money, the probability of realizing the maximum risk on this trade, which is going to be $400, is almost not even detectable. I mean, it's there, but the probability is so small that you really can't say that I mean, you have to say this is what I'm risking, right? But you really can't say that's what I'm risking most of the time. Right? If I put on one trade and the market just absolutely skyrockets to the upside and I happen to lose that $400, well, that's going to be an outlier. That's not going to be an average losing trade on these. It's going to be an outlier. And what I'm going to do if the market skyrockets like that is I'm going to put on another one. And what's the probability of the market skyrocketing again like that? Very, very, very small. And in fact, what I would probably do is I'd probably skew it to a much bigger credit if the market were to do that. And so this is one of those where the Monday, Wednesday calendars, I think, is a great strategy that somebody can focus on and not worry too much about a $400 loss on a single trade. It's going to happen once, maybe in a couple of years type deal in current market conditions. Now, if SPY tanks and you put on the same trade and you're not that far out of the money, then all bets are off. This is what I'm talking about in relation to the current conditions where we're making or we're close to being at new market highs, and the probability of these big massive jumps to the upside over a short period of time are just not very realistic. However, everything changes. If SPY drops 30 points over the next couple of weeks, it can just as easily go right back up 30 points, right? So we have a completely set of conditions. This is why I call it the triple play options. We have to deal with or three different volatility levels. You cannot put on the same trade week in and week out with the volatility changes in SPY. When volatility is lower, you can better focus on certain trades. When volatility is higher, you can focus on different trades, or you can focus on similar trades, but you have to make sure you can go way out of the money with those things, knowing that a bigger bounce is more likely after a bigger sell-off. Okay, all right. So I wanted to go through that so that you could mentally go through yourself and say, okay, you know what? If I were in a Monday, Wednesday, and I'm 5 points in the money, I'm not going to suffer the maximum loss most of the time in that scenario with this type of trade. Okay, so let's scroll on down here and see where, if I'm in a credit of 1. Right, here's a 388, 392 calendars. We're trading at 395.32 right now, and this is a credit of 18. So this is 3 points in the money. 3 points in the money, and I have a small loss. And there's still extrinsic value on this 392 call. It's trading at 372. We're trading at 395.28. So there's 50 cents of extrinsic value on these 392 calls that still are there. So this actually, excuse me, this actually could turn positive, could turn into a debit before the end of the day, depending on where we're at. Okay, here we go. This is 2 points in the money. And look at that. If I'm in a credit of 0.1, I now have a profit of 60 bucks. It's a pretty wide bid-ask spread. You can probably get out at 60 on this one. And so that is, that's a very, very decent average on a weekly basis. If you can average $60 a week, you're doing great. Let's keep going. Here's the 390, 394s. Is that $1.35? Here are the 391, 395s. That's at 203. Actually, I think this is slightly, I'm going to regenerate these prices, and I think they may have not been completely updated based on the market right now. So let's see here. Yep, I think it got stuck. So hang on 1 second. I'm going to go ahead and save that, and I'm going to come back into it. All right, so crazy calendars, Monday, Wednesday, open it up. 385, 400, so let's go ahead and generate. That should, there we go. All right, so here's a 389, 393s again. So 393s right now, that's, and we're trading all the way back up to about almost 396 now. So this is almost 3 points in the money, and it's at a debit, 9 cents. At 390, 394, 96, that's a $100 gain. 391, 395s, that's 1 point in the money, right, as of right now where we're at, $1.77. Here's the at the money, 237. Right, so if you're in from a credit of 0.1, that's a $237 profit. This is out of the money by 1 point, 242. Out of the money by 2 points, 221. Out of the money by 3 points, 194. Out of the money by 4 points, 169. So in other words, these things that are out of the money, they are holding their value really well, so that you have a really high probability of seeing a profit on these trades if they're short term. All right, so let's take a look. Since that's the case, let's see if there's anything that we can take right now. I'm going to go ahead and reset these. So this is 454547. So we're going to take a look and see if there's anything available right now. Holy cow, these hours go by so quickly anymore, don't they? Let's see if we can generate a credit out here. There we go, 58, 42. So this is at the money, 392, 396s. I don't want to do that, even though it's at a credit 43. I don't want to do this because we're right at the profit peak, right? So we're basically, the market is basically trading right at this profit peak. And I like to put these on so that that profit peak is way out of the money. But you'll notice, let's see, the farthest we can go is 395, 399 for next week. But 395, 399 this week is trading at $1.89 debit. So this has about $190 time value on it. So if the market goes nowhere over the next week, this is going to be worth about $190 in profit, right? So I can do that, and that pushes the profit peak out to 399. I am a little bit more bullish on this. I'd prefer to go a little bit further out if I could. So this one is at about a debit of 0.5. So that's, if I've got a credit working somewhere else, I might say, okay, if I've got an overall credit, let's say I'm on like 3 different trades in SPY and I've got an overall decent credit, then I may look at this one and say, you know what, I'm willing to get in at a debit 0.5 in order to go a little bit further out of the money so that I have a profit peak at 400. And again, so this week, by the way, markets are closed Friday, so there will be no market action on Friday. So we'll probably move up based on seasonals into Thursday. We might move up to 400, maybe 401 on Thursday, but then there's no market action on Friday, which puts this at the last day, basically at the close on Thursday, and we only have one market action day left on Monday. So it might actually be a really good trade to get into this. If you are even a little bit more bullish, then you might want to go 397, 401s, maybe 398, 402s. But that one, look, that one's already trading at a debit of 19. Okay, so that's one that expires basically in 4 days. Let's take a look at ones that expire next week or the following week. So this is basically 2 weeks from today. And you'll notice here that we can go, here's 396 400s, credit of 38 cents. Now the issue that I have with going, so on the Monday and Wednesdays, you're not going to have quite as much time decay the first week. You're going to have some because I can get this one at a credit of 0.1, let's say, that expires in 1 week. So in 1 week, I can presume that this 38-cent credit, if the market goes nowhere, it's going to be making me about $38-ish, somewhere around there, right? So that's how I project it, and that's how I get that. But if I want to go a credit, then I have to go a little further out. Here's a 399 403s. So I can do that at a credit of 4 cents. And if the market really goes higher this week and kind of hovers there, then I'm going to have, I'm going to have a pretty good position in place with a profit peak at 403. 5 points past this would be 408. So the market would have to go from where it is now to 408 by 2 weeks from today in order for me to see about $140, maybe $150 open position loss on that trade. It's certainly, for me, it's worth it. So I'm going to do both of these. I'm going to do one for next week that expires this week, and I'm going to try and get it at a small debit, although, man, it seems to be, where are we at? We're at 390, so we're just under 396. Yep, I'm going to do this one. And so let's see here. And I'm going to go ahead and do it at a debit of 4, even though I'm just going to do that so that I can potentially get filled, so that we can watch this together, kind of thing, like we do with everything else. All right, so that's in place, and I'll let you know if that is filled. Then I'm also going to do the, let's see, I'm going to do the, yep, I'm going to do the, so I'm going to do this one. Come on. So I'm going to do this one as well. So I just did the 405, the 4547, and I'm also going to do this one with the 399 and the 403s as the profit peak. Okay. All right. So, and that one is at a credit of 04. You know what? I may not get filled on either of these because of the 4. That's the issue with these. The one issue with these spreads is that I may have to drop that down to a 1, 2, 3, and then put on the extra calendar after I get filled. So I'll probably do that in a smart fill, or excuse me, a smart order file. All right. Last thing that I wanted to cover was, where are we at? Where is it at? There we go. This one. This particular trade is one that we started on, let me find it. We started on Thursday, and the market was trading, of course it was trading down, and it was a 390, 392, right? All right, so let's pull this out. This is, of course, the cash flow spreads. I told you we're going to go over like everything today. And so this is what was filled. 326. I was filled while we were on the call, and it's just a really small diagonal, so there's not a lot of risk to the upside, but there is a little bit of risk to the upside. 390, 392. And you'll notice the long is way out here at 416 expiration, and this 390 call was actually expiring on Friday. Okay, and so Friday comes around. Friday opens, and we're kind of meandering around and whatnot. And what I ended up doing is I ended up getting out of the 390 call and selling the 391 call. All right. And I did that for $1.50. So I got out of that one and I sold a 329, 391 call. And I actually got out of this one at a small loss. It was filled at 148. All right. So I took a small loss on that short because the market moved up. Ended up getting into a 391 call as opposed to a 390 for $1.50. So I actually brought in about the same amount of credit that I exited the Friday. I brought in on Monday. Only this is the one that I sold the put on. I didn't sell a call, I sold a put. And so I ended up exiting that at 07. So this graph does not actually show you what I actually did. But nonetheless, this one expires today, and we're trading at 395.14 right now. Okay. So if I were to get out of this one, where is that trading? Because I didn't. I actually, when I got out of the put, I ended up selling this one at a more time value this morning. But we are trading right now at 4. Looks like about 480-ish. Whoops, need to exit out of that one. All right, so let's just assume that we get out at 480. or we would if I had actually done this right. So 480. And now we need to replace that immediately because I've got this 392 long that expires on 416, right? So I actually do this as a spread. I would not exit one and not simultaneously get into another. Okay, want to make sure everybody understands that. I would not exit one without simultaneously getting into another, because if I did, I would have this long call naked, and it's worth that 416 call right now. Let's see what that's worth. The 392 is trading at about $8. $8. So if I don't sell something else, I've got $8 worth of long call that's going to drop on me. All right. So you have to sell it at the same time. And so, this, of course, the next one to sell is not the 4-1, it's the 331. And so the question is, what one do I sell? And it's really not, let's see, three. So the first one that I would consider would be 391. And let's just find out where that one's at. So let's do that. So that 391 that expires on Wednesdays at 526. And so this is the graph that is created. So again, I still have some risk up here, but I am selling some additional premium. My risk if the market tanks is at $200, but I'm going to most likely have an opportunity to resell before it tanks. If it crashes, then it is what it is, right? But if it meanders down on Wednesday or stays the same, then I'm going to be able to sell another one, and I'll sell the following Mondays, or I could sell the following days, which is Thursday, since there's no Friday expiration. If the market moves up, then I'm just going to have to continue taking that loss. My long will continue to gain value, and I'm going to either sell another put, or I'm going to wait for the market to come back down a bit. Well, you have to sell another put, period, end of story. If you hold on to the long, you have to sell another put. You can't come up that much, though, right? Because the more you come up, the less premium you're going to bring in. And you remember, whatever premium you bring in has to offset what the value of that long is. And so that's the key to keep in mind. All right, so let's up this just a bit so you can see what happens. And I can do this as long as I'm bringing in the same amount. I can move it up a little bit more, right? And by moving it up a little bit more, 392, I bring in 447, which is basically almost what I exited the 391 for. So I'd bring in 447. And again, that makes my risk very, very small to the upside, a little over $200 to the downside, but I've got this, so I'm banking on selling again and again and again. And even if I'm going in the money, you can see I'm bringing in some extrinsic value. So if I go with the 392, and right now we're trading at, where are we at right now? We are at 396 exactly. I'm still bringing in 47 cents. Whoops, 47 cents. Let me get that back down there. 47 cents of extrinsic value if I get filled at 447. If I sell a 391, that's 5 points in the money. I still have 26 cents of extrinsic value, and that's fine because I'm playing this on the long term, right? I've got until 416 to keep selling and selling and selling and selling, and I can be very patient with this thing. And so, it may be a little bit slower from time to time, but there are times where you're going to sell the at the monies 2 or 3 times, and you're going to have this $300 profit, in a matter of a week. And then there are going to be times like today where I basically am holding on to a small break even. Based on where the long value is, I'm making significant amount of money on the long, and I've already taken a small loss, taken another loss, type deal. But my long is worth quite a bit, right? So I'm going to have to figure out how to get back into the proper spread after I get out off of this call, because as I mentioned, when I resold the 391, it wasn't the call, it was the put, and so that falsely inflated my profit, my actual profit on this trade, than what it should be had I not made that mistake. All right, so we'll continue to watch this. You can certainly put one on right now. You can put one on that's out of the money, and you can put another one of these on every 5 points. You can put another one of these on every week, and you can just be rotating. There's all sorts of ways to do them. You just have to have a plan, and you understand what that plan entails. All right, I know I covered a lot. Again, if you're new on the call, there's a lot of great ideas here. The purpose is not to do everything, but rather pick one and become really, really good at it. And then you can add later, but pick one and then just keep learning and watching and learning and watching, et cetera, et cetera. All right. Let's see, Don, I totally get the compounding plan, but wondering if you can share exactly how to execute this when you're trading larger trade size lots. Are you placing the same trade multiple times to get the appropriate trade size? So, if I put in a trade, let's see here. So if I put in a trade, whoops, maybe it will come down here. All right, there we go. I'm pretty certain you're talking only about the compounding plan, but let's say I have this trade, and let's say it's a 1-2, right? If I'm doing multiple lots, I can do a 5 lot, and that'll be filled just fine. All right, that's a 1-2 trade with a 5 lot. If I start with a 5 lot, which I don't suggest that you do, Don, but if you start with a 5 lot, then yes, you can go from 5 to 10, 10 to 15, 15 to 20, 20 to 25, et cetera, et cetera. You have to use a delta that's 5 times the size. All right, so let me pull this back up. Where are you? All right, so let's go back up to this graph here. All right, so this one is a delta of 100. So you start with 2,500, your first increase is at 2,600. And then it's 2 times 100 on top of the previous equity. And then it's 3 times 100 on top of the previous equity. That's how this equation works. It's very, very simple. But if you were to start with 5 lots, then you'd go $500. So obviously you need more than $2,500 to do a 5 lot. So let's say you have 10 grand in the account. Your first increase would be at 10,500. You go from 5 to 10. And then you would go at 11,500, you'd go from 10 to 15. And then at 13,000, you'd go from 15 to 20. Okay, so it's exactly the same ratio. All right, when you say they may push it to 400, who is they and how do they push? They are the evil bots at Wall Street. Big players, big investors, big traders. They're the same ones that pushed the market up on the first calendar day. So people that move money, big, large amounts of money, lots of hedge funds, mutual funds, etc. Hello, Ryan. What happens if and you got to understand when I say 400, they're pushing the individual stocks up, right? And they kind of keep tabs on the overall broad market, but that is a level that is that they're looking at. What happens if I own a non-even number of call contracts on UVXY and they do not, and they do a reverse split? They'll probably just expire worthless, is what will happen. Will you be moving Thursday call to Wednesday? Probably not, Stefan. I'm probably going to keep it on Thursday. And it'll be a unique last day. But I definitely will not go past 2 o'clock or 3 o'clock Eastern if that happens, because I will be in trades that I need to pay attention to. Edwin Carter, traded April 5th, April 7th, 391, 396 trade and bought to close my short legs Friday. Today I added 431 March calls at around 11:30. Edwin, excellent. So you did the 400? You did that without even watching this. Do you know how happy that makes me that you did that? It shows that I am well, I can't take that. It shows that you understand it, is what it shows. So that's excellent. For financing calendars, when creating a credit spread on a call side, keeping a buy out of the money and keeping the sell to the in the money, the credit keeps increasing. Is there any risk if we move the sell to an in the money, deep high in the money, and take a big credit? Yeah, there is risk. So on these crazy calendars, where is my crazy calendar? Man, once y'all get me moving those windows around, it's almost impossible to find them again. Y'all like how I did that? Once y'all get me to move these windows around. So I successfully projected the blame onto you guys. And I can't find my PDS Trader window that I had open. There it is. What happens if you create a, let's put this way in the money and have a huge credit. So this is what happens. You create this dead zone. And so you do have to be careful of this dead zone if you do that. And you also have to be careful of the distance between the 393s and the 401. So now all of a sudden, for example, in this example, you actually have a 8-point strike difference between your short and the long. So be wary of that. Let's see. The problem is that at the moment you enter the diagonal plus crazy calendar. The problem, entering a diagonal plus crazy calendar Monday, Wednesday, the price of the long is much higher than the price of a Friday. Yes, Guido. So the credit is smaller on the Monday, Wednesday, but so is the debit when you exit. So give a little bit of one, take from another. Take from one, give. It's almost like algebra, right? So you give in one area, you take from another. You take from one area, you give in another. How can we quantize different level of volatility into numbers like implied volatility? No, it's really not, because it depends on the day. It depends on whether there's it depends on whether there's an announcement coming out, the Fed announcement coming out that's going to push the volatility higher until it comes out, and then it's just going to die immediately. So I really can't, because, for example, Wednesday's volatility is going to be, around 15, 16, 17%, based on what we're seeing today, right? And you're not going to see that on Mondays, right? So just having a different day is going to create that difference. This may already exist, but could you provide a cheat sheet that maps the recommended strategy to increasing, decreasing flat volatility? Increasing, decreasing flat volatility. Oh, I see what you're saying. I really haven't done a cheat sheet. That might be a good idea, though, Scott. I'll consider that. Since time decay accelerates during the last 30 days with regard to cash flow spread, should we make a point to exit the entire trade 1 week before the expiration of 416? That is, Barry, that is excellent thought. We haven't gotten there yet. I did mention this briefly, but yeah, I will not hold on to the 416 long through 416 at all. As you will watch me, and we'll talk about that in detail as we get closer to that. On Clash Flow says there's always a credit. Strikes. There are enough expirations from. So on cash flow trades, there's always a credit on the roll of identical strikes. Therefore, if there are enough expirations from time you put the trade on to expiration of the long, isn't the real risk on these types of trades rather small? Yes, Barry. Overall, generally, the real risk on these trades is rather small, because there is almost always a little bit of credit that you're able to sell. If it moves up too much, then that's not going to be the case. You're just going to be stuck selling the same strike with no credit and waiting for the market to come back down, and giving you the ability to then bring in some more premium at some point. Sometimes it is a waiting game. Let's see. They are some crafty devils. Yeah. Yes, indeed, John. I understand. I'm trying to wrap my head around how to interpret low, mid, and high levels of volatility into something tangible. Stefan, the best way to do it is based on where the market is, comparison to where it has been. And then just understanding the different volatilities on the different expiration days, based on however many days are left. You can't. We're in low volatility right now. Period. End of story. It doesn't matter what day you use. Doesn't matter anything. We're in low volatility right now. All right. So hopefully that helps. You bet, Barry. All right, we are. Looks like I got all the questions. I hope you enjoyed the call today, and I will see you guys on Thursday. Yes, I will be doing it on Thursday, even though the market, that is the expiration of this week. So no changes this week, and I will see you on. Your question on UVXY. I didn't see a question on UVXY. Actually, I did answer a question. Was that yours, Juan? Yeah, I did answer that. I said they'll probably expire worthless. If they do a reverse split, those your calls are probably going to expire worthless. So it doesn't matter where you own non-even or none of that matters. So let's see. All right, now I get everything. Oh, Dano, one question I missed here. On the new crazy calendar trades for today, what prices are you willing to chase to get filled to 4244 in the 412? So I was doing a 4-cent credit on one and a 4-cent debit on the other. And where are we at now? We are at let's see here. So we're actually trading up at 396.36. So the issue, I think, is going to be the 134. I'm going to have to do a 1, 2, 3, and then I'm going to have to put on the extra calendar spread after that, because I don't think they're going to fill me on the 4 lot. Oh, my lands one you bought September. Oh no. One. That was a major mistake. Sorry to be, I got to be blunt with you. That was a major mistake. So UVXY is associated with the futures, right? So they buy the futures and then they hold the futures until expiration, which means there's contango going on, which means that long-term UVXY calls as a hedge is no bueno. Because it moves down. UVXY moves down. The only thing that's going to move it up is a tank in SPY. If SPY stays the same, it's going to move down. If SPY moves down a little bit, it's going to move down. And so you really have to do those short term, or else you're going to get, they're going to become way out of the money really quick is what happens. And you will have paid quite a bit of money for those. So I don't know if you can get out with a small loss and replace it with a much cheaper, much closer UVXY call, but I would look at potentially doing that. I rarely go more than a month on these. So UVXY, yes, UVXY basically and essentially goes to zero over time. That's why they do the reverse splits, to keep that ball rolling. $400,000 invested in UVXY 6 or 7 years ago is basically worthless. And $400,000 invested in UVXY today will be virtually worthless. And so why don't people do that? Why don't people short sell UVXY? Because of a crash will kill you. That's why. So, all right, you bet. Hope that helps. All right, guys, that's it. Everyone have a wonderful day. I'll see you on Thursday.